Ladies and gentlemen, this is Financial Secrets, and I need you to stop scrolling right now. I need you to step away from the charts, forget the indicators, and listen with full attention. Because what just happened in the silver market changes everything we thought we understood. For years, we told ourselves a simple story about good versus evil. We believed the banks were trapped. We believed JP Morgan was drowning in a massive short position. We believed that when silver finally broke free, the banks would be destroyed. We believed this rally was a punishment. We believed we were winning. But the truth is far more disturbing. We were never squeezing them. They were positioning us. New intelligence has surfaced that completely rewrites the history of the silver market. JP Morgan did not lose control during this rally. They took control. They didn't get crushed by rising prices. They designed the rise. Deep analysis of vault movements, warehouse data, and long-term positioning reveal something shocking. JP Morgan is no longer short. They are massively long. And not on paper. They are long physical silver, an amount so large it changes the entire market structure. Current estimates point to roughly 750 million ounces under JP Morgan's control. Let that number sink in. This is not a trade. This is dominance. It is more silver than any private entity has ever held in modern history, more than legendary hoarders of the past, more than most public exchanges combined. This hoard alone represents the majority of the annual global mine supply. And if you own that much of an asset, you do not want the price to fall. You want it repriced. This revelation flips the entire narrative on its head. The largest force behind silver suppression is now its greatest beneficiary. JP Morgan didn't fight this breakout. They stepped aside. They let it happen. Every dollar silver rises now strengthens their balance sheet. This explains why resistance levels failed without a fight. This explains why the price exploded upward instead of stalling. This is not chaos. This is execution. For over a decade, while retail investors protested manipulation, JP Morgan was quietly accumulating. They used paper leverage to push prices down, and while prices were crushed, they bought physical metal at discounts. They turned suppression into a shopping strategy. Now the accumulation phase is complete, and the incentive has flipped. The biggest silver holder on the planet now wants higher prices. That means the market floor has changed forever. The question is no longer if silver rises. The question is how far it must rise to satisfy the new power structure. This also explains something deeply unsettling. We are no longer fighting JP Morgan. In a twisted way, we are aligned with them. We want silver higher for protection. They want it higher for profit. Different motives, same direction. And when the most powerful bank in America decides an asset will reprice, it reprices. They have the capital. They have the political insulation. And now they have the metal. But to understand how they pull this off, we need to go back. Not last year, not even the last decade. We need to go back to the financial crisis. Because this plan began in the shadows of 2008. At the center of that collapse was Bear Stearns. Most people remember it as just another failed bank. What they don't remember is why it failed. Bear Stearns was deeply entangled in silver shorts. When JP Morgan absorbed Bear Stearns, they inherited something toxic, a massive paper position that could have destroyed them. But instead of closing it, they weaponized it. That short position gave them control over price ceilings. And control over price means control over supply. For 15 years, that inherited position was used to smash rallies. Each smash forced weak hands to sell. Each sell created physical supply, and JP Morgan was always the buyer. They built private vaults, expanded custodial access, positioned themselves at every choke point of the physical market. What looked like manipulation was actually preparation. They were draining the market ounce by ounce. Retail frustration funded institutional accumulation. But every scheme has an endpoint, and that endpoint is driven by something no bank can manipulate forever. Geology. Mines deplete, grades fall, deficits grow, and eventually paper promises fail. That moment arrived recently. Sometime in late 2025, JP Morgan quietly closed the remaining shorts. They went neutral. Then they went long. The suppression engine was shut down, and the price was allowed to run. What you're seeing now is not speculation. It's a vacuum. And it's accelerating into something much larger. What makes this moment even more dangerous is the timing. JP Morgan didn't just flip long randomly. They did it at the edge of a global supply shock. Because while the West was distracted by charts, another force was moving quietly in the background. China? In just a few days, a new export restriction comes into effect. Not next year, not someday, in days. This policy will restrict silver flows leaving China. And China is not a minor player. China is one of the largest refiners and processors of silver on Earth. When that gate closes, global supply tightens instantly. JP Morgan knew this was coming long before the headlines. They always do. Banks don't trade rumors. They trade information. By the time the public hears the news, the position is already built. JP Morgan positioned themselves ahead of the blockade. They secured metal while it was still available. Now they sit between producers and consumers. This is where the market truly breaks, because silver is not just an investment metal, it is an industrial lifeline. Solar panels require it. Electric vehicles depend on it. Electronics cannot function without it. When supply tightens, industry panics, and panic buyers don't negotiate, they pay. This is why the current price is misleading. $79 is not equilibrium. It is anticipation. The real move begins when factories realize inventories are gone. When procurement desks discover there is no spot market left. When contracts cannot be fulfilled. At that point, price stops being discovery. It becomes rationing, and the entity with the largest hoard becomes the decision maker. That entity is JP Morgan. They don't need to dump metal, they can simply wait. Every day they wait, deficits widen. Every week they wait, and desperation grows. This is not a short squeeze. Short squeezes are violent and chaotic. This is a corner. Corners are slow, controlled, and brutal. The price walked higher, step by step. Resistance turns into support. Support turns into memory, and the floor keeps rising. This is why $100 silver is no longer a target. It is a requirement. Below that level, supply cannot rebalance. Below that level, industry cannot function. And above that level, JP Morgan's leverage becomes absolute. Because once silver crosses triple digits, psychology changes. Investors stop selling, hoarders tighten their grip, producers demand higher premiums, and central planners lose control. This is where the narrative flips again. Silver stops being a trade. It becomes a strategic asset. Governments take notice. Defense departments take notice. Energy planners take notice. And when governments compete with corporations for metal, the price explodes. JP Morgan understands this dynamic perfectly. They are not chasing price. They are guiding it. They will allow volatility to shake out leverage. They will tolerate pullbacks to reset sentiment. But they will not allow collapse, because collapse hurts their own balance sheet. This creates a hidden floor under the market, a private backstop, a JP Morgan put. And this is the uncomfortable truth retail investors must understand. The bank that suppressed silver for years now protects it, not out of kindness, out of self-interest. But alignment of interest is all markets care about. This alignment changes the risk profile entirely. The downside becomes temporary. Upside becomes structural, and time becomes the weapon. As the China restriction begins, headlines will focus on trade, but the real story will be inventory. Who has it, who doesn't, and who controls access? By the time that reality sinks in, the price will already be higher, because markets move before understanding arrives. This is not the end of the story. This is the transition point, from accumulation to extraction, from suppression to monetization, from disbelief to panic. And in the next phase, the victims will become visible. Industrial giants, tech manufacturers, energy producers, all discovering at once that silver is no longer cheap and no longer available. At that stage, the blame game will begin. Executives will point fingers at procurement teams. Procurement teams will blame outdated forecasts. Analysts will blame unexpected demand. Politicians will blame geopolitics. But none of that will matter, because markets don't care about excuses. They care about availability. And silver availability is collapsing. This is the moment when paper promises fail. ETFs look liquid until delivery is requested. Futures look deep until contracts stand for metal. Then the truth surfaces. There is far less silver than advertised. Years of leasing masked the shortage. Years of rehypothecation hid the risk. The same ounce was sold multiple times. On paper, supply looked abundant. In reality, vaults were thinning. JP Morgan saw this imbalance early. They reduced paper exposure. They increased physical control. They converted contracts into metal. This is not speculation. This is inventory management at a sovereign scale. And now the rest of the market is late. Late buyers pay penalties. Late buyers accept worse terms. Late buyers get rationed. This is how a commodity transitions into a controlled asset. It doesn't happen overnight. It happens quietly, then suddenly. 1 week shipments are delayed. The next week orders are canceled. Then force majeure clauses appear. Factories slow down. Margins compress. Stock prices react. And only then does the public realize silver matters. By then, financial secrets will already be discussing the next phase. Because this channel is not about reacting. It is about positioning. While headlines scream manipulation, structure tells the real story. While influencers argue price targets, supply curves are breaking. While retail debates timing, institutions secure access. This is why patience beats prediction. You don't need the exact top. You need exposure before scarcity. That window is closing. Not years from now, not months from now. This quarter. As inventories drain, volatility will increase. Sharp rallies will be followed by violent pullbacks. This is design behavior. It shakes out weak hands. It discourages late entrants. It transfers metal from emotional sellers to strategic holders. JP Morgan understands human psychology. Fear sells, hope buys. They will weaponize both, but every cycle leaves evidence. Backwardation will deepen. Lease rates will spike. Premiums will decouple from spot. These are not opinions. They are signals. Signals that physical stress has reached a critical point. When that happens, central banks step back. They cannot print silver. They cannot mandate production. They can only react. And reaction always costs more than preparation. This is the advantage of early awareness. This is why understanding structure matters more than price. This is why Financial Secrets exists. Not to hype, not to panic, but to expose what others miss. The next phase will not be comfortable. It will challenge assumptions, it will punish complacency, and it will reward those who prepared quietly. As this pressure builds, liquidity will become an illusion. Screens will still show bids and offers, but size will disappear. Large orders will move the market instantly. That is never a healthy sign. It signals fragility. When markets are fragile, power concentrates. Those with inventory dictate terms. Those without inventory accept reality. This is where silver separates speculators from stakeholders. Speculators watch candles. Stakeholders secure supply. JP Morgan is not watching charts anymore. They are watching flows, shipments, refining capacity, warehouse movements. These are the metrics that matter now, because once physical bottlenecks form, they cannot be solved quickly. Mining projects take years. Permits take longer. Capital arrives last. By the time new supply appears, price damage is already done. This is why the coming move will feel unfair. There will be no warning bell, no countdown, just a series of events that look unrelated. A delayed shipment here, a refinery outage there, a regulatory announcement buried in fine print, individually insignificant, collectively explosive. This is how systemic stress expresses itself, not through one headline, but through many small fractures. Financial Secrets has tracked this pattern before. It always ends the same way, with repricing, violent, irreversible. Once repricing begins, narratives scramble to catch up. Suddenly silver is critical. Suddenly it is strategic. Suddenly it is essential to national security. But the smart money already moved. They moved when it was boring. They moved when it was ignored. They moved when suppression felt permanent. That is the irony of markets. The biggest shifts feel impossible right before they happen. Right now, disbelief is still dominant. That is a feature, not a flaw. Disbelief keeps prices contained. Disbelief allows accumulation. Once disbelief cracks, containment fails. And when containment fails, acceleration begins. This acceleration will not be smooth. It will not reward impatience. It will punish leverage. Margin calls will cascade. Forced selling will create temporary crashes. Those crashes will be bought instantly, because underlying demand will not disappear. Industry cannot substitute silver easily. Efficiency gains are already exhausted. Recycling cannot scale fast enough. There is no hidden stockpile waiting to save the market. This is a structural shortage, and structural shortages resolve through price, always. The only unknown is magnitude, not direction. As this unfolds, noise will increase, opinions will multiply, confidence will sound louder than understanding. This is when discipline matters most. You don't react to noise, you observe structure, you follow the flow, you respect scarcity. That is the mindset Financial Secrets is built on. The final phase begins when denial turns into urgency. That shift is subtle at first, then sudden. One earnings call mentions input constraints, another warns of cost pressures. Then guidance is pulled entirely. That is the tell. When companies stop forecasting, visibility is gone. And when visibility is gone, risk premiums explode. Silver will be blamed publicly. But privately, executives will scramble to secure supply at any price. Long-term contracts will be rewritten. Spot purchases will spike. Premiums will detach completely from futures pricing. This is when paper markets lose authority. Physical markets take control. At that point, price charts become history books, useful only for understanding how wrong everyone was. JP Morgan will not announce victory. They never do. They will simply report higher revenues, stronger balance sheets, better positioning. The public will call it luck. Insiders will call it preparation. And preparation always beats prediction. This moment has been building for years. Low prices discouraged investment. High demand consumed inventories. Regulation slowed expansion. Each decision made sense in isolation. Together, they created a trap that is now closing. This is not a bubble forming. This is a shortage revealing itself. Bubbles collapse when demand disappears. Shortages end when supply expands. And supply cannot expand fast enough. Not this cycle. Not with these constraints. This is why patience remains the most valuable asset. Chasing spikes will lead to mistakes. Ignoring pullbacks will preserve conviction. Understanding structure will protect capital. This is the difference between gambling and positioning. Financial Secrets does not gamble. It decodes. It observes. It waits. And then it acts when the odds are asymmetric. And that window still exists. Barely, but it exists. As long as disbelief remains, opportunity survives. Once consensus shifts, the door closes. History will not remember the exact day silver broke free. It will remember that most people missed it, and that a small group understood it early. This is the moment we are approaching. Not tomorrow, not years away. Now.